So we now move on to the second and final review on financial analysis techniques, that is reading 28 of the CFA curriculum. So we'll cover some of the remaining ratios, starting off with the DuPont analysis that deals with the return on equity, ratios used in equity valuation, how to calculate a company's sustainable growth rate, take a look at some industry specific ratios, and wind up with the ratios used in analyzing business risk, credit, and segment analysis. So of the many ratios that we studied in the previous review, one ratio that is of great concern to the shareholder is the ROE, also known as the return on equity. The return on equity is calculated as the net income upon the shareholder's equity, also known as the book value. The shareholder's equity represents the total investment made by equity shareholders in the business. And please recall that the net income all belongs to the shareholders. So ROE essentially is the return that the shareholders are getting for the money that they have invested with the firm. Now, because the ratio is so important, we calculate a more detailed breakup of the ROE using the DuPont model. So the derivation of the DuPont equation is quite simple. So ROE is net income by equity, or I can say it is net income by sales into sales divided by equity. If I multiply and divide by the same number, the ratio will not change. This can further be broken up as net income upon sales into sales upon assets into assets upon equity. This breakup is called the original DuPont equation, and it breaks up my ROE into the net profit margin multiplied by the asset turnover multiplied by the leverage ratio. Or if the ROE of a company has to change, then one of these three aspects need to change. Either the net profit margin should go up or down, the sales turnover, that is the sales for the assets employed, should change, or the leverage ratio should increase or decrease. Analyzing the ROE in this format will give us more information and will help us make better judgment as to whether this change, increase or decrease in ROE, is sustainable or not. So if the ROE is increasing just because the leverage is constantly going up, the margins and the asset turnovers are constant or are decreasing, then we know that it's not a sustainable phenomena because there are limits to the extent of leverage that we can take. Similarly, any one of these aspects becoming too extreme or going up or down by a very high number would normally not be sustainable. So there will be a limit beyond which you cannot increase your margins or your asset turnover. So analyzing the breakup helps us understand the ROE better and also helps us predict the future ROE better. So let's understand the DuPont model with an example. Glad Incorporated has maintained a stable and relatively high ROE of approximately 18% over the last 3 years. Use traditional DuPont analysis to decompose this ROE into its three components and comment on trends in company performance. So please remember, the original DuPont breaks ROE up as the net margin, that is the net income upon the sales, multiplied by the asset turnover, that is the sales upon total assets, multiplied by the leverage ratio, that is the assets upon equity. So we've done the calculation for the year 2010 here, and we can compute the ROE as 16.67%. We could have also directly computed the ROE, that is 25 upon the equity of 150, which would have also given us 16.67%. But the original DuPont helps us understand the breakup better, as we'll see. So similarly, we can break up the ROEs for 2011 and 2012 and derive that for 2010, the 16.67% was a product of a 9% net margin, a 1.38 times asset turnover, and a leverage ratio of 1.33. Likewise, for 2011, we can see that the ROE of 13.33% can be broken up as net margin of 5.71% multiplied by a turnover ratio of 1.27 and a leverage ratio of 1.83. The ROE in 2012 has fallen further down to 9% with a similar split. So we see that the ROEs have been trending lower for this company primarily because of a lower net profit margin and a lower asset turnover ratio. Even though the leverage ratio has been going up, the loss on the other two aspects has been bringing the ROEs down. So this company should definitely work on bringing its net profit margin and asset turnovers back, as the leverage ratio already seems to be quite stretched. So let's do one more example. A company has a net profit margin of 10%, asset turnover of 1 times, and a debt to assets ratio of 50%. What is the ROE? Please note that the question in the exam will not come with a heading that use original DuPont. So please make sure that you've practiced enough questions to know what is the best way to go about once you read the question. So from the original DuPont, we know that the ROE can be broken up as net margin into the asset turnover multiplied by the leverage ratio. Now, the first two aspects have been given to us straight up. That is, the net profit margin is 10% and the asset turnover is 1 times. The leverage ratio, please recall, is the total assets upon the equity, and what is given to us is the debt to assets ratio, that is 50% or 1 by 2. So if we assume that assets are 2x, debt is 1x, then equity can be calculated as assets minus debt, that is 2x minus 1x equals to 1x, which will give us the assets upon equity as 2x upon 1x equals to 2 times. Or the ROE can be calculated as 10% into 1 into 2, that is equal to 20% for this company. Now I can further break down the original DuPont to derive the extended DuPont. So instead of writing the ROE as net income upon sales into sales upon assets into sales upon assets into assets by equity, I can further break this first term as net income upon PBT into PBT upon sales, which can further be broken as net income upon PBT into PBT upon EBIT into EBIT upon sales, and the remaining two terms remain the same, that is the sales upon assets into assets upon equity. So this is the formula for the extended DuPont. The first term in this analysis, that is net income upon EBT or profit before tax, is called the tax burden. The profit before tax upon the EBIT is called the interest burden. See, this is because this ratio tells us how much lower is the profit before tax from the operating income or the profit before income and tax. Similarly, the first ratio tells us that how much lower is the net income from the earnings before tax, and the only metric between the two is the tax burden. EBIT upon revenue is the operating profit margin or the EBIT margin, and the asset turnover and financial leverage remain the same from the original DuPont. So an analyst has gathered data from the two companies in the same industry, calculate the ROE for both companies, and use extended DuPont analysis to explain the critical factors that account for the differences in the two companies' ROE. So the entire income statement and relevant metrics are given for both Alpha and Beta Incorporated. So we first need the net income upon the earnings before tax. So that will be 350 upon 500 as the tax burden, multiplied by the EBT upon the EBIT, that is the interest burden of 500 by 600, multiplied by the EBIT margin, that is 600 upon the revenues of 1500, multiplied by the asset turnover, that will be 1500 upon the total assets of 1000, multiplied by the leverage ratio, that is total assets upon equity, or 1000 by 400 for Alpha Incorporated. We can name each of these ratios. EBIT margin, asset turnover, and the leverage ratio. We can similarly do the breakup for Beta Incorporated and compare the significant differences. So Alpha has a slightly lower EBIT margin to the tune of 5%. It has a better asset turnover, so more sales per unit of asset employed. It has a higher interest burden, that is, more of the EBIT has been taken away in the form of interest as compared to Beta Incorporated. A better financial leverage or higher leverage ratio. And we see that the two companies have a similar tax burden. So the ROE for Alpha Incorporated is slightly better than Beta Incorporated. So Alpha has 87.5%, the product of all these values, while Beta having 75%, mainly coming from the differences that we just saw. We will take a quick look at some of the ratios used in equity valuation. So valuation ratios like the price to earnings multiple, price to book multiple, price to cash flow, etc. help us determine whether the company is relatively undervalued or overvalued, as we'll study in more detail in the review on equity valuation. We've already studied some per share measures like the basic EPS and the diluted EPS in the review on the income statement. And just to revise, diluted EPS is a hypothetical calculation assuming that all potentially dilutive securities are exercised. Just like we calculate the earnings per share, we can also calculate the total cash flow per share or the operating cash flow per share, the EBIT per share, so on and so forth. An important metric that is often seen is the dividends per share, that is, how much cash is the company returning back to the shareholders in the form of dividends. And the dividend per share divided by the earnings per share is called the payout ratio, which we will use for predicting the sustainable growth rate in the coming slide. Sustainable growth rate is the long-term growth rate that the business can hope to achieve in its earnings and dividends. So we'll do this soon with an example, but remember that real growth requires reinvestment, or without reinvestment a firm cannot grow. Let's assume there is a company A with assets of $100 funded entirely by equity of $100, and in the first year of operations the company does a sales of $100. All expenses, taxes are a total of $50, giving us a net profit of $50. Now we know that the entire net profit theoretically belongs to the shareholders. So let's assume that the company pays the entire $50 earned in year 1 out as dividends, or there are no retained earnings. Given this information, what would be our best estimate of the sales in year 2? So there has been no reinvestment in the business. The asset worth 100 would remain or would probably depreciate a little. So in the best case, I would be able to maintain my sales of $100, assuming the asset was fully utilized earlier, and I'll have expenses of $50 for manufacturing, taxes, etc., giving me a net profit again of $50. So if I don't retain any earnings or I don't reinvest in the business at all, then I would be able to maintain my net profit in the best case, that is, maintain my dividend level of $50, but there would be no growth. In the same case now, let's assume that at the end of year 1, $25 were reinvested back into the business as retained earnings, and $25 were paid out as dividends. In such a case, my equity will go up by $25 because of the retained earnings. They still belong to the shareholders, but I'll pay them out at a later date. At the moment, I'm investing back in the business. So I'll be able to increase my assets as well by another $25. In case 2, what will be my revised estimate of the sales in the second year? Assuming that my capacity is ramped up to full utilization, with $100 of assets, I could do $100 of sales. With $125, I'm estimating that I'll be possibly able to do $125 of sales. Of course, my expenses will also correspondingly go up from $50 to $62.5. That is, the additional $25 will have additional $12.5 of cost, giving me a total net profit now of $62.5. We now notice that the net profit has increased by 25%, that is from $50, it has become $62.5. If we decompose this growth, we will see that the original asset of $100 was able to sustain the earnings. The growth in earnings has come because of this reinvestment that we did, which is resulting in additional earnings, causing a growth over the previous year number. So the growth in earnings can be calculated as how much I choose to retain, that is the retention ratio. Please note this entire retention is additional and hence it's causing growth, and the return that I'm able to make on that money retained. So multiplied by the return on this additional equity that I have generated. So in our example, the retention ratio was 50%, that is half of the net profit was retained and reinvested in the business, and the ROE of the business, which we are assuming will be maintained, is also 50%. For an equity investment of $100, we were making a profit of 50. For an equity investment of 125, we are assuming the profit will be 62.5. So retention ratio into the sustainable ROE will be the sustainable growth in the business, in this case a number of 25%. So remember, growth requires reinvestment. The return earned on the reinvested earnings causes a growth in the original earnings. Growth is RR into ROE. Retention rate is the net income minus the dividend, that is the retained earnings upon the net income, which can also be written as 1 minus the dividend payout ratio that we calculated earlier. The dividend payout ratio is the dividend upon the net income. So let's do an example. The following figure provides data for 3 companies, alpha, beta and gamma. Earnings per share, dividends per share, return on equity is all provided. Calculate the sustainable growth rate for each company. Let's first do it for Alpha Incorporated. So the sustainable growth rate is equal to the retention ratio into the ROE. The retention ratio for Alpha would be 1 minus the dividend payout ratio, that is 1 minus 3 upon 10 or 70%. And the growth would be equal to the retention ratio into the ROE, that is approximately 8.4%. Similarly, for Beta Incorporated, it would be 1 minus 10 by 20, that is 0.5, into the ROE of 15%, which will be 7.5%. We see that Gamma Incorporated has a very high retention ratio. The payout ratio is only about 0.33%, that is about 97% of the earnings are being reinvested into the business, which is generating a high ROE of 18%. So the growth comes out to be 17.4%. Please note that such high growth rates are normally not sustainable. That is, this company is probably a young company which has a lot of opportunity at the moment. As the business becomes bigger and becomes more mature, the payout ratios should increase, the ROE should come down, and the sustainable growth rate should come down a little. So there are some other specific ratios that are used by various industries. The net income per employee and the net sales per employee are very common metrics that we use to judge the performance of IT companies, service companies and consulting companies, where people are the major raw material. Growth in same-store sales likewise is a very popular metric in the retail industry to understand the overall business environment and the economic environment for the industry. Sales per square foot is also used to measure the performance of malls and other retail outlets. And likewise, there are many other industry-specific ratios that companies sometimes employ. There are ratios that help us gauge the risk in a business. So we remember from the review on quantitative analysis that standard deviation is a very common measure of risk. High standard deviation indicates higher risk. However, standard deviation has the same unit as the underlying data. So comparability becomes difficult in case I have different units or data from different categories. For example, the standard deviation in kgs cannot be compared with the standard deviation in meters or percentage, so on and so forth. So to make the standard deviation comparable across categories, we compute something called as coefficient of variation. And the coefficient of variation is calculated as the standard deviation divided by the average. We studied this in statistics as well. So the coefficient of sales as a ratio becomes comparable across industries and across different companies, and a high coefficient of variation would indicate higher risk and vice versa. Similarly, I can check for the standard deviation of operating income, that is EBIT, and compute the coefficient of variation. I can compute the coefficient of variation of the net income. So these ratios tell us about the risk in the business and are also important calculations that go into financial analysis. Banks, insurance companies, and other financial firms use more specific risk ratios. For example, the capital adequacy ratio, which puts a limit on how much equity the bank must have invested at any point in time, the value at risk, the minimum reserve requirements for the amount of loans that the bank has given, the minimum liquid assets that the bank should carry at any point in time, the net interest margin that the operations of the bank are making, etc. So don't have to go into the details of these ratios, but know that there are more specific risk ratios that different industries can sometimes use. Another interesting and important use of ratio analysis is in the field of credit analysis. So credit analysis deals with a company's ability to service and repay its debt. Servicing debt means making interest payments in a timely manner, and you also have to repay the principal as the debt matures. So various coverage ratios that we've studied, the interest coverage ratio as the EBIT upon interest, sometimes we calculate it as the EBITDA upon the interest, or the return on capital, the debt to assets, financial leverage, cash flow ratios that we've studied, can all be used to determine whether the firm will comfortably be able to meet its debt obligations or will it have some trouble. Finally, it also makes sense to do a ratio and financial analysis for each segment of the business. A business segment is defined as a portion of a larger company that accounts for more than 10% of the company's revenues or assets and is clearly distinguishable from the company's other lines of businesses. So if I have a cement business and I also have a significant portion of revenues coming from textiles or chemicals, then each of these lines would be a separate business segment. Sometimes for the same business, the segments can be defined by geographies. So India may be one market, Europe may be another market, so on and so forth. So geographic segments are identified when they meet the size criteria and are in different geographies. So each of them should be at least 10% of the revenues and present in different geographies. So it definitely makes sense to do a detailed analysis and forecast separately the performance of each business and each geographic segment. So the segment-wise profit margins, utilization ratios, return on assets can be very useful for future projections and to get a better picture of the firm's overall operations. So we see that one part of the business may be very profitable, whereas some other part may be dragging the cash flows and is causing a loss to the company. So growth rates of the segment revenues and profits will eventually help us in estimating the future sales and profits of the overall company. So that was about the review on financial analysis techniques. Please make sure that you revise and you remember all the ratios that you read in this review. Practice a lot of questions so that you know how to apply these ratios in real world situations. We'll continue to use a lot of the ratios and the analysis that we've studied in this review in many other parts of the CFA curriculum. So thanks a lot and see you next time.